Namaste, welcome to Arthaniti. Today I am posting a video after quite some time, but the reason to make this video today is to tell you about the new ELSS scheme. Now we are approaching the financial year end in March 2023. If you have not started tax saving, this is the time that you need to do it. Don't wait till the last month and then in a hurry uh, invest in schemes which are not going to give you good enough returns. Well, today I am here to talk about a new ELSS scheme which was launched by IIFL Mutual Fund. Now, this scheme is open for subscription from 1st December till 21st December. What is different about this scheme other than the in comparison to the other ELSS schemes which are already in the market? Well, this is the first passive ELSS index fund. Okay, now I'll explain what this is. Till now, what happened is whichever mutual funds had ELSS, equity linked saving schemes, the tax saver mutual fund, were all actively managed. Okay, in May 2022, SEBI gave the nod for mutual funds to come out with passive ELSS schemes. Right now, what is the difference between actively managed and passively managed mutual fund? The basic difference from the viewpoint of the investor is a passive mutual fund does not have a fund manager who keeps on making investment decisions based on the changes in the market. Okay, this is passive investing. So obviously the expense ratio that is charged to the investor is less in a passive mutual fund as compared to an active mutual fund. So this is an advantage when it comes to the investors. Right now, what is an ELSS scheme? In short, ELSS is a scheme in which you can get up to 1,50,000 rupees of tax saving under section 80C of the Income Tax Act. Right, so there were many ELSS schemes which have been running over the years, but the first passive ELSS scheme has been launched by IIFL. Why? Because only it's not even 6 months that SEBI has given nod, has permitted mutual funds to come out with passive ELSS schemes. Now, it being a index fund, what it means is it is going to invest in companies which form part of the index. Now, which is the index that it is going to follow? This particular scheme is going to follow the Nifty 50, the National Stock Exchange Nifty 50 index. So, it will be investing in those companies which form part of the Nifty 50 index. Correct. Now, with a passive index fund, what happens is the returns that are generated from those funds mirror or replicate the returns that the particular index generates. Now, if you look at Nifty 50 index, the history of returns of the Nifty 50 index over the past 10 years, this fund has given returns of around 10 to 11%. Correct. So, what advantage this passive mutual fund ELSS scheme is going to have is from the investor's point of view, obviously, it is going to be a threefold advantage. The investors will be charged less expense ratio, so they'll have to pay less charges to the mutual funds for, say, administrative expenses, marketing expenses of the mutual fund, management expenses of the mutual fund will be very low as compared to an actively managed mutual fund. Now, ELSS mutual fund is the best tax saving option that is available to you with the least lock-in period. There is a lock-in period of only 3 years. Compare it to other ATC options like PPF, wherein you have to keep your money for 15 years or a 5-year FD. So, this is the lowest lock-in period which is available for investors with tax saving option. Correct. And thirdly, it is an index fund. So, the returns that that will be generated from this scheme will replicate the index which is benchmark for this fund. In this case, it is Nifty 50. Correct. So, if you have still to make tax saving investments, IIFL passive ELSS index fund is one which you cannot ignore. If you want to invest in this fund or if you want to know any more details about this, please feel free to contact me. Correct. Now, today I just wanted to share this much because this was a very new, this is a new scheme that is being launched by IIFL and the first passive ELSS scheme. So, take advantage of it. Okay, see you. Bye.